Good morning, one and all. Today, we Group 6 is here to give a presentation on the topic Technical Analysis. Before moving on to the presentation, let me first introduce my group members. They are Aishwarya Ganesh, Ajay Krishnan, Rishikesh, Anne Maria, and myself Sri Lakshmi P. So, here we will be discussing about what is technical analysis, different techniques of technical analysis, and some charts. Moving on to the presentation, before discussing about technical analysis, we can have a look at what is stock market. Stock market is a place where shares of public listed companies are traded. Analysis of stock market is very important, which gives us relevant information about the value of the stock. There are two tools for analysis, fundamental analysis and technical analysis. Here we are going to study about technical analysis only. What is technical analysis? It is a study of historical stock prices and the stock market behavior to identify recurring patterns in data. Here they use historical price to determine future price. And technical analysis study price movements, trading volumes and data on a number of rising and falling stock issues over time to predict future patterns. This process requires large amount of data and it is a time consuming and tedious process. Technical analysis only considers quantitative data such as price and other trading variables and it does not take into consideration the qualitative aspects. Next, there are two assumptions on which the technical analysis is grounded. First one is all historic price and volume patterns exhibited by a stock represent the total market perception of what is known or knowable about the individual stock. That is, past price and volume behavior is indicative of future movement. Second one is the market does not move in a random manner. That means long-term patterns develop in the market which has sub-trends within them. Then we will discuss about the techniques of technical analysis. Technical analysis uses a variety of tools and techniques to spot trends in the market. Some of these includes relative strength index, moving average, pattern differences, etc., which we will be discussing here. The first one is relative strength index, RSI. It was developed by Wells Wilder. It means it measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock of other assets. That is, it identifies the inherent technical strength and weakness of a market. RSI is calculated by using a formula which is given here. If RSI crosses 70, there may be downturn, and if RSI falls below 30, there may be an uptrend. So this index also often forms chart patterns. Next, a chart pattern of RSI is depicted here. Here we can see two zones, overbought zone and oversold zone. If RSI is rising in overbought zone, it indicates a fall in price, and if RSI is in oversold zone, it indicates a rise in price. So that's all about the relative strength index, and other techniques we'll be discussing in the coming slides. Thank you.
Good morning, everyone. My name is Ajay Krishnan. So let's look into the topic moving average. A moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data over a specified period of time by creating a constantly updated average price. A moving average is calculated by adding a stock's price over a certain period and dividing the sum by the total number of periods. A rising moving average indicates the security is uptrend and declining moving average indicates the security is downtrend. Moving averages are totally customizable indicator, which means that an investor can freely choose whatever time frame they want when calculating an average. The most common time periods used are 15, 20, 30, 50, 100 and 200 days. It is a simple tool usually calculated to identify the trend direction of a stock or to determine its support and resistance levels. The longer the time period for moving average, the greater the lag will be, or the shorter the time span used to create the average, the more sensitive it will be to the price changes and vice versa. So let's look into the type of moving averages. There are two types of moving averages, SMA and EMA, that is simple moving average and exponential moving average. Talking about SMA, it is a symbols form. It is calculated by taking arithmetic mean of a given set of values. In other words, it is a set of prices are added together and then divided by number of prices in the set. So the mathematical expression is SMA is equal to A1 plus A2 plus up to AN divided by N, which indicates A is equal to an average period in N and N is number of time periods. And second is EMA, that is exponential moving average. Exponential moving average is a type of moving average that gives more weight to the recent prices in attempt to make it more responsive to new information. To calculate an EMA, you must first compute the simple moving average over a particular period. Then you must calculate the multiplier for weighting EMA, referred to as smoothing factor. Then you use the smoothing factor combined with the previous EMA to arrive at the current value. The EMA thus gives a higher weighting to recent prices, while the SMA assigns equal weighting to the old values. The mathematical expression is as follows: EMAT is equal to VT into S divided by 1 plus D a whole plus EMAY. EMAT is equal to EMA today, which is value today, and EMAY is EMA yesterday, and S is equal to smoothing, and D is number of days. So that's all about moving averages. It's a simple tool used in technical analysis. Thank you.
Welcome you all to the presentation. This is Aishwarya Ganesh and this is going to be about stock chart. In stock charting, we read the previous movements of stock that we want to analyze. This allows us to estimate the future price movement of the stock given in the prior movements of stock. That is, we simply use historical data to analyze the future outcomes. This is the basic principle of technical analysis. So coming to the stock chart. Stock chart is a tool used in technical analysis to analyze the price patterns and trends of the stock in market. It gained popularity in late 19th century from the writings of Charles H. Dow, which often known as Dow theory. Stock chart is a simple two-axis plotted graph of price and time which look like this. In this, we can see the price is shown in the y-axis and the date or period shown in the x-axis. In 2018 January, the price of the stock was $1,200 and in October it nearly came into $2,000. So it illustrates the movement of price over time. It shows the combination of opening, closing, high and low prices of the market session, or it's simply price bar. So this is the clear representation of a stock chart. It is more famous and we often seen this in TV and other stock marketing platforms. It clearly shows the trend of price over date or period. We can see the up and down of these lines which shows the fluctuations of price through time period. So let's look into the type of charts. There are 4 different kinds of chart we are going to discuss. First one is bar charts, second one is line chart, third one is candlestick chart, and fourth one is point and figure charts. So these are the pictures of bar chart and line chart. Sure, this doesn't look like a bar chart, but it is a bar chart. And the second one is line chart, which is very obvious. The trend is shown in this chart very clearly, and the other charts are candlestick chart in the first position and point and figure chart in the second position. So in point figure chart, the 0 or O means the low price and X means the highest price. So next we can discuss about bar chart. I know this doesn't look a bar chart, but it is a bar chart and we can discuss about it. Bar charts are used to convey price activity into easily readable chart. All charts do make the analysis easy. So it is also easing the process by plotting these charts. This charts also known as OLH OHLC charts, which is opening low, high close charts. This chart capture OHLC over a period. It can be 1 minute to 1 month according to the analyzing team. So the next point is chart doesn't have a body like candlestick chart. Candlestick chart is another kind of chart which is having a body, but we can see that bar chart is not having that body. It's simply plotted in the graph, and it also uses for technical analysis. We already discussed about that part. It is used for technical analysis of stocks. So let's look into this portion. This shows the bar graph into a very zoomed version. So in this, total length of the bar represent the entire trading range, and the next top of the bar represent highest price of the stock in that particular period, and the bottom of the bar represent the lowest price of the period. Open is represented by small dash to the left of the bar, and close represented by the small dash to the right bar. So let's look into this picture very clearly. So there is called open, which is the point that we opened the stock into market, and it opened at very low price, but it ended at very high price, that is close. Here it ended at very high point. But in the next figure, the red graph, which shows it opened their stock in a very high price, but it ended up in very low price. So the bar graph shows high and low value of the share, and also the opening and close of the stock over a period. So it's pretty obvious that the bar graph shows the opening and closing of the stock as well as the high and low end of the price.
Hello everyone, myself Anne Maria Joseph. Now we are going to discuss about the topics, the line charts and the candlestick charts. First of all, let's see what is a line chart. A line chart is the simplest type of chart. The single line represents the security's closing price on each day. Dates are displayed along the bottom of the chart and the prices are displayed on the sides. It is simple and easy to understand the security's price. It is typically displayed using a security's closing price. So, this is a line chart. Here we can see a single line. This single line represents the security's closing price on each day. Days are displayed along the bottom of the chart and prices are given on the sides of the chart. So, by looking into this chart, we can easily understand the price fluctuation of this given stock within a particular time frame. Here, this chart shows the time frame from September 11 to March 26. So, this line chart effectively shows the price trends of the stock from September 11 to March 26. But the problem with this chart is that it only shows the closing price of the chart. It will never show the opening price, high price or low price of that stock during that particular time period. So, the greatest strength of this line chart is its simplicity. Anyone could easily understand by looking into this chart and could understand the trend of the stock, and he can easily predict the future price. Now let's see what are candlestick charts. So a candlestick chart is a representation of stock price movement which comprises of small units called candles. So in this candle chart, we can see the price movement of the stocks, and this price movement are represented through small units called candles. A candle contains detailed information regarding the opening price, closing price, and daily high price and low price of the stock. And they are also more visually appealing than a bar graph. If analyzed well, It helps to predict the direction of price movement. Now let's see what is a candle. A candle represents a price activity in a stock in a particular time frame. This is the diagram of a candle. Here we can see the opening price, closing price, high price and low price of the stock in this particular time frame. The body of the candlestick is called the real body. This rectangular part is the real body of this candlestick and it represents the range between the opening price and the closing price. And the vertical line above or below the body is called the upper or lower shadow, and this represents the price extremes of the stock during this particular time frame. And this candle can be of any color. Commonly we can see it in red and green color. So in this candlestick we can see the variation or the difference between this opening price and closing price of that particular stock, and we can see that the price opens at this particular price and it goes up and it goes down and it reaches this particular point, and finally it reaches at this particular point which is lower than the opening price. Also, these type of charts date back to 17,000, and earlier Japanese traders used this for predicting rice prices. There are two types of candlesticks. There are bullish candlesticks and bearish candlesticks. Bullish candlesticks represents buying activity in a stock in a particular time frame. A white or open body means that the closing price was higher than the opening price, shows more activity from buyers. Next is bearish candlesticks, which represents selling activity in a stock in a particular time frame. A black or filled in body represents closing price was lower than the opening price, shows more activity from the sellers. This black colored candlestick is the bearish candlestick, and we can see that in this type the closing price is less than the opening price. This means that there is less demand for this product at that particular price, so the seller kept on decreasing its price and it reaches at certain price, that is the closing price, which is lower than the opening price. This shows that here the seller's activity is more in this case. The next one, that is white one, is the bullish candlestick, and here the closing price is more than the opening price. Here the closing price is higher than the opening price, which indicates that this stock or share has demand. So even if the seller keeps on increasing its price, there are buyers to buy this product. So this price kept on increasing and it reaches at a certain point, that is closing price, which is higher than the opening price. So in this case buyer's activity is more than the seller's activity. Here the buyer's activity is more. So this is a candlestick chart, and now we could easily understand the pattern or the price fluctuation of that particular stock in this particular time period. This black candlestick shows that the closing price is lower than the opening price for that stock in that particular time period, and the white stick represents that the closing price is higher than the opening price for the stock in that particular time period. So by analyzing these charts effectively, the investors or traders could make fruitful decisions regarding their investment or selling or buying of the stocks. He could easily analyze or predict the future stock price. Daily candlestick is based on the opening price, intraday high and low price, and the closing price. So this daily candlestick shows opening price and closing price of that particular day, and the weekly candlestick shows Monday's opening, Friday's closing price, and the weekly high price and low price range. Investors believe that this candlestick charts are very easy to understand and it provides detailed information regarding the stock price movements. So, by making use of these techniques, investors can make effective decisions regarding the future investments.
Good morning. I am Rishikesh, and today my topic is pattern analysis. Pattern analysis is the oldest form of chart analysis. So, technically speaking, in a stock market, the value of the asset may increase or decrease, and this procedure of increasing and decreasing, it is also known as a trend in the market. And the transition between rising and falling trends are often signaled by price patterns. So by definition, a price pattern is a recognizable configuration of price movement that is identified using a series of trend lines or curves. So according to the market value, the value of the asset may increase or decrease, or the value of the stock may increase or decrease in the market. So this is known as trend and it is indicated by trend lines. When a price pattern signals a change in trend direction, so if the trend in the market is increase in the value of the asset and the price pattern signals a change in this trend, it is known as a reversal pattern, and a continuation pattern occurs when the trend continues in its existing direction. So if it continues to be in the trend that is existing in the market, it is known as continuation pattern. Support and resistance level. Technical analysts use support and resistance levels to identify price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. So in the market, we can see an increasing or decreasing trend for the value of the asset. So here, the trend is paused at certain zones. Those are indicated by resistance zone and support zones. So there, at these zones, we can identify the price points. At an increasing price level, there exists a resistance zone to prevent further increase, and at a decreasing trend there exists a support zones to the support the trend so that it will not further decrease. And at the resistance zone, the price of the asset will be higher and there will be more sellers there, and at the support zone the price will be much lower and there will be more buyers there. Support is a price level where a downtrend can be expected to pause due to a concentration of demand or buying asset. As the price of assets or securities drops, demand for the shares increases, thus forming the support line. So, as the price of the assets, as I had said earlier, as the price of the assets decreases, there will form a support zone to support the value of the asset to prevent further decrease. And always it is not possible to prevent, because if there is a price action occurs, it will break the support zone. In the case of resistance zone also, if there is a price action or a high volume business of stock, if there are more people to invest in this stock, there will be a break in the resistance zone and it will increase further increase. So here, as the price of the assets of securities drops, demand for the shares increases, thus forming a support zone. Meanwhile, the resistance zones arise due to selling interest when prices have increased. So, as the price of the asset increases, the sellers will be eager to sell their assets, so that there will be more sellers at the resistance zone. As the price and demand for the and as the price of the assets or securities drops, there will be more buyers, because the demand of share will be increased at the support zone. Once an area or zone of support or resistance have been identified, those price levels can serve as potential entry or exit points, because as a price reaches a point of support or resistance, it will do one of two things: bounce back away from the support or resistance level, or violate the price level and continue in its direction until it hits the next support or resistance level. So once it reaches a support level or resistance level, it will either bounce back, that is, once it reaches the resistance zone, it will bounce back and come to the support zone, and when it reaches the support zone, it will bounce back and target to the resistance zone. And it can also be violated, and we can see that here the resistance zone has been violated and the trend has been moving to another resistance zone, and the support zone also have been violated and the trend is moving downwards to another support zones. In this case, The initial resistance zone will be served as a support zone for further increasing trend, and the initial support zone in a downtrend can act as a resistance zone for the downtrending value of assets. Thank you.
So here we coming to the conclusion. Technical analysis is a trading discipline employed to evaluate investment and identify trading opportunities by analyzing statistical trends gathered from the trading activity. Techniques of technical analyzing like studying price movements, trading volumes, and data on the number of rising, falling stock issues over time will help to forecast. Through various kinds of techniques, technical analysts can forecast future values. So that technical analysis is helping investors to invest better and maintain the stocks in the market efficiently. So the technical analysis is helping the investors to know the market and how the price of the stocks are fluctuating in the market, so they can invest in a better way, so they can earn better profit from the stocks. Thank you.